about this? Is this any better? Hello, hello? Hopefully the static sound should be gone now. Better. Awesome. Let's turn up the volume. Alrighty. Okay. So again, quick disclaimer. This is all for educational purposes, not financial advice. Please do your own research. That's the whole point of this, to share with you all the research that I've found in the hopes that you can do your own research and come to your own conclusion. And today we have a second disclaimer because we're going to talk about a little bit of politics. I don't care about politics. The point is not to talk about politics. If you want that, go turn on the news. The goal here is to simply talk about the stock market. I want to look at how elections impact the stock market and look at key policy that both candidates have and how that policy might impact our investments. It is not saying I agree with one and disagree with the other. That's not the point. The point is to share with you all the facts about what we know and explain how that will impact the market. And out of respect to everybody, I would love this to be a conversation about economics and investments, not politics. So please, let's stick to the topic of investments. If you've got something interesting to add to the conversation, please do. But let's avoid promoting one candidate or trying to put down another candidate. That's not the point. There's enough of that in the world already. We don't look at red or blue here. We look at green. Money, and that's it. Cool. Let's just answer the big question right up front. Do elections impact the stock market? Yes. Yes, they do. Thank you all so much for joining. I hope you... No. Let's dive into that answer a little bit more. Because yes, they do impact the stock market, but there's a lot more detail that goes into it than just that. So we're going to look at how stocks typically react to elections or how they've reacted in the past to elections. Let me make sure I can get the subtitles working for you all because I just realized that those aren't keeping up. The magic of live television, right? Microphone. Alrighty. Now we should be good to go with subtitles. Yeah, there we go. Cool. So we're going to dive into the answer of do elections impact stocks by looking at how the stock market has reacted to past elections, if stocks care about if it is a Democrat or a Republican that wins the election, how and if elections impact other types of investments, namely bonds, and how all of that has impacted our investments so far in 2024. And then finally, we will end off with a little bit of my opinion about what could happen from here. So starting off, why does politics matter for investments? Well, the whole answer is very, very simple. The stock market hates one thing: uncertainty. The stock market really likes to know what's going on and have a good guess about where things are going from here, especially when it has to do with money. And the reality is, stocks are a risky investment. Now, risk is relative, okay? What's risky for me is skydiving. Someone else is going to think skydiving is a blast. But the reality of it is impossible to say that skydiving is somehow less risky than going for a walk in your neighborhood, right? I think we can all agree on that. So stocks are an investment that carries more risk than something like bonds. And the reality is there are factors that increase risk. And those things are typically bad signs for the market. The stock market does not like things they can't control or that they can't predict. And all of those factors that they can't control increases risk. So reality is new leadership in not only the president's seat, but also House and Senate, aka Congress, does mean that there is a chance for sharp changes in economic policies. Big words, let's boil that down. When the new guys come in, often they're going to look at think about it like this. You move into a new house, you look and you say, I don't like the color of the walls in that room. You repaint it. You look in the backyard and you say, I don't really like that there. You take it out. You redo the lawn. You redo the flowers. It is very normal when you move into a new place or a new apartment to make that place exactly how you want it to be. Congress, president, no different. They're moving into a new house and they're saying, I don't like the color of the walls that they had in there before. I'm going to change the colors. Same thing goes for economic policy, and economic policy has bigger kind of reasoning or bigger results than changing the color of the walls. Because those economic policies directly impact the performance and profits that companies can have. And that's where our whole conversation is going to focus. Now, this is Sectors Made Simple. Let's quickly talk about sectors, and then we're going to move past it. Not all sectors will react the same way to changes in leadership. We will see some sectors love whoever wins, while other sectors can't stand them. That's the reality. Because some policies from either party will benefit some sectors and will harm other sectors. For example, Democratic leadership is more likely to push for renewable energy and conservation efforts. Green energy, more investment into nuclear programs for energy, incentives for electric vehicles, for solar panels. All of that is part of the Democratic agenda. So, certain sectors, like utilities, will benefit greatly. The largest holding in XLU is Next Era Energy. Next Era literally tells us they're focused on renewable energy sources. Nuclear, wind, solar, hydro. They're going to benefit if a Democratic person is put into power because they're more likely to get funding for expanding their power grids, to make their energy cheaper, to get subsidies from the government, anything that helps them along. So utilities will likely benefit greatly. Meanwhile, energy will get hurt. Now, it's kind of funny to think utilities will do well, energy won't, but you got to remember that energy is mostly oil and gas companies. So what happens when we're moving towards green power and moving away from oil and gas? Well, what that means is that we are going to probably see oil and gas companies, their profits are going to go down, their stock price is going to go down. So that is what we would expect to see if Democrats were in office. Republican leadership is more likely to scale back investment into renewable energy. They might see it as useless or might see it as unnecessary, and instead they will favor oil and gas. So that's going to cause the opposite effect. Energy, oil and gas companies are going to skyrocket. Utilities companies based in renewable energy are going to fall. This is just one example, though. And there are so many examples like this, and unfortunately, it's really hard to talk about historical data. I don't want to just get up here and start spewing off a bunch of information and say, trust me, it works. Not how we do things here. I like to base as much as I can in facts and information, share those sources with you so you can come to your own conclusion, and I can't do that if we don't have historical data to go off of. So we're going to table our conversation about sectors here for right now, because I want to look instead at what we can historically track. Major indices. This is going to be where we can focus our attention. So we're going to look at three major groups of companies. The S&P 500, which are 500 of the largest companies in the US stock market. we're going to look at the Russell 2000 small cap companies, and then the Dow Jones Industrial Average, 30 companies spanning across a bunch of different sectors. The reason, I want to see the S&P 500, the biggest companies, and how they're reacting. But at the same time, big companies will react differently to global events than small companies. I wanted to see, do small companies react more to the results of an election? And then lastly, the Dow Jones mixes things up a little bit, because while the S&P 500 is market cap weighted, meaning the value of each company is determined by its size, the Dow Jones is price weighted, meaning the share price is what is used to dictate that group. So a little bit of a different way of looking at it, but similar goal of looking at performance of everything, just in a slightly different way. We're going to take a look at how these indices have performed over a few different periods of time. A little bit about 1 month, but we're mostly going to focus on 6 months and 1 year after the election, and then divide up those returns based on if the new president, the incumbent president, was a Democrat or a Republican. Let's get started here with the S&P 500. We have data for the S&P 500 back to 1987, giving us a number of elections to work with: 88, 92, 96, 2000, 2004, 2008, 2012, 2016, and wrapping things up with 2020. Over that entire period of time, I wanted to break out returns into 4 different chunks. November 1st of election year, so that would be like right now, or 4 days ago, to November after the election. That would be the year after the election. Election year plus 2 is the year after that. Election year plus 3 is the year after that. And then year before the election would be last year. So November 2023 to 2024. And the goal is to see, do we find a clear trend here? And the answer is yes, we do. We find that the best returns for SPY are in the 1 year after an election, and the worst returns are the year before the election and the year after the election. Well, rather, the year after the election year. So that would be from November 2025 to 2026. That's the period of time we're talking about. But the really interesting thing is that the returns will change depending on if we look and say a Democrat won or a Republican won. In elections where a Democrat won the election, that upcoming year, we saw an average of 22.56% profit for the S&P 500. So a Democrat gets elected. In the year after that election, the market went up on average 22.56%. That number for Republican presidents was just 6.07%. Less than a third of the results of a Democrat. Now, I want to be very fair here. My whole goal is not saying Democrat good, Republican bad. A lot of that is due to the year 2000 being an election year and the dot-com bubble bursting right after. It is not fair to say that that is a normal market. So for all of the metrics we're looking at here, I am taking out the 2000 election so we get a little bit more of a fair comparison. So if we take 2000's election out, what we get is an average return of 16.72%. Still, 16.72 compared to 22.56. So what we can say is that over the past almost 40 years, the elections have always favored a Democratic candidate more than a Republican in the year after that election. Now, the Dow Jones, very similar story. For the Dow, we only have data back to 1992, so we lose one election. But we see a very similar story. In the year after the election, that is the best year, while the year before it is the worst year. Why? Probably because people don't like random change. People don't like not knowing what's going on. And once again, look at what we have here. The year after, the period after, I need to find better terms for these, election year +2, let's call it. Why do we think that that year was almost as low, or in some cases is lower, than the year before the election? Any guesses? Because I've got my theory. Elections for president happen every 4 years. Elections for Congress happen every 2 years. So we can break this up. Year after the presidential election, year before congressional elections and state propositions. Year after state propositions in Congress, year before the election. So really what we have is 2 separate election cycles. We've got one that we are preparing and getting worried about what's going to happen for president, and then the other where we're getting ready and getting worried about what's going to happen for the state. And that is what we see happening for both the Dow, but also the S&P 500. The years after these elections, be it midterm elections or presidential elections, are the best periods, while the years before them are the weakest. Let's break this out once again by candidate. If the new president being elected is a Republican, the average return of the Dow Jones was 5.36%. If we take out 2000, it goes up to 16.6%. Democratic candidate, 19%. So once again, the Democratic candidate or a new Democratic president is favored over a Republican president since 1992. And then finally, we have the Russell 2000. Here we see slightly different results, but not really. Because the election year still has the best returns. The second best year is the midterm election year. And then the year before and the year after, or the year before midterms and the year before the elections are the 2 weakest years out of the entire cycle. So again, we've got up, down, year after year after year. Breaking it out by candidate or breaking it out by party, in an election year where a Republican president is elected, we see an average gain of 9.2%. That goes up to 16.9% if we take out the dot-com bubble. The 1 year results, so the election year +1, the average is a loss of 6%. Election year for a Democratic president, 29.2%. Massive. I'm going to go out on a limb here and say that's almost well beyond what we could draw a conclusion on. Like, that is so far outside of what is reasonable to say, oh, it's just the change of president that caused that. But we can't rule that out completely, because in the year after that, there was 0% change. So that negative 2.67%, that average year's return for a Republican president of 6%, that goes away. And instead, we see no change at all. Why would that be? Well, my personal opinion, small cap companies benefit greatly from things that provide more funding for these small businesses. Small's a relative term, all right? Typically, what we will see are Democratic presidents will prefer to provide support for communities and for individuals and believe that a lot of the success of everyone comes from supporting us from the ground up. Republican candidates typically will choose this idea called trickle-down economics, where if the big companies don't have to pay as much in tax, have more tax breaks, and don't need to pay as much, then they're going to give that money back. They're going to keep products cheaper, and they're going to, give some of those profits back to the company. That money is going to trickle down to everyone else. Whether that's true or not, I'm not here to talk about that. But the stock market does put its money where its thoughts are. And the trend here is pretty darn clear. Democratic candidates are favored significantly more in small cap companies compared to Republican candidates. So much so that in the year before a midterm election, the results go from a 6% loss to a 0% gain or loss. That is sizable. Can we say that that's everything? No, but that's more than just a coincidence. So the key takeaways from that: overall, the stock market responds positively to elections. In all three cases, we have positive gains of double digits after an election year. So the stock market's not about to crash, okay? The stock market typically loves, or in my opinion, it's not about to crash. The stock market loves after an election is over because now they know what to expect for the next 2 years. Over the past 9 elections, the stock market has responded more positively to a Democratic incumbent president than they have a Republican president. But that big difference becomes a little bit smaller, or a lot a bit smaller, if we remove the dot-com bubble, which is why we looked at all of those numbers excluding the year 2000. So, is 2024 going to be any different? Because I don't know about you guys, this does not feel like an average election year. This is record turnouts for an election. People are way more passionate about politics this year. Can we really say that past results give us an idea of what to expect when this is the current political climate? I don't know. We have no clue. But let's look at the economics. Again, I don't care about the politics. I just want to talk about the economics. So let's look at the key economic policies for both candidates and see just why everyone thinks that this stock market year is going to very much depend on who wins and who loses. Starting off, let's look at the Democrats' economic plan. Starting off with taxes. Democrats, part of their tax plan for 2025 is that they want to cut taxes for 100 million Americans. By that I mean they want to reduce how much we're paying. The less you make, the larger the tax cut will be. For the lowest income bracket, the amount of that tax cut will be around 7% on average. If you make more than $900,000, you will actually be paying more in taxes. That is the only tax margin that would be paying more in taxes under this plan. But that's a lot less money. So current estimates by the Wharton School of Business estimate that reducing taxes in this way will actually increase how much money we are losing, the federal government is losing, by around $1.2 trillion over the next 10 years. So about $120 billion per year. They are going to try and offset that. They're going to try and make that amount of deficit go down by increasing taxes on the wealthy, again, $900,000 or more in income, and large businesses. Democrats believe that large businesses feel that trickle-down economics works and the Democrats think it does not. They think that corporate profits have gone way too high, and they want to start taxing businesses more and hope that they can recoup a lot of that $1.2 trillion by taxing businesses their fair share. We don't know how this will impact businesses. I couldn't find any data because it's all just guesstimates at this point. But again, to provide you with one final number, we do know if you make more than $914,000, you are the only tax bracket that would have your tax amount go up under the Democrats' plan. And you would be paying a whole 4.1% more in taxes. The other element, or the other part of the economic plan from the Democrats that I want to talk about is already in motion. It was enacted in 2022, and it's called the CHIPS Act. The CHIPS Act aims to increase the production of semiconductors here in the United States. Right now, over 80% of the world's semiconductors are produced by Taiwan. Over 90% of the advanced microprocessors are produced by Taiwan. The US, both parties, Democrats and Republicans, want to reduce our reliance on Taiwan and foreign countries for one of the most important building blocks of any technology product. Cars, phones, tablets, computers, everything. Everything needs semiconductors. So this is a very important act. Again, it was passed in 2022, and it allocates over $100 billion to building manufacturing plants here in the US, research and development for semiconductors, and incentives and tax benefits for companies to produce products here in the United States. When will this start? Well, it already has. This act has already resulted in Taiwan Semiconductor Manufacturing, one of the largest producers of semiconductors in, you guessed it, Taiwan, opening up a manufacturing plant here in Arizona. That move is already happening, and many other companies are following suit. There are plans by Micron, I believe, to open up another plant here in the US. Many companies, both US companies but also foreign companies, are taking advantage of this opportunity. Taiwan Semiconductor is just a prime example of that. The goal here is to create new jobs. Straight up. We want to bring more jobs to the US, but also reduce our reliance on foreign countries, especially foreign countries that are in potential conflicts with others, so that we don't have to worry about one country supplying everything that we need to be a technology advanced society. So how are these policies going to impact stocks? Well, let's look at that. First, the tax side of things. If companies are being taxed more, that's going to reduce their company profits. Lower company profits means a drop in share price. That's the sad truth of it. The Democrats' plan to increase taxes for large companies and decrease taxes for the average American will probably result in stocks losing some value. And there is a potential, but in my opinion, a very small chance that the decreased profits result in higher costs that we have to pay for things like groceries. I don't expect that to be a big problem. I think it's mostly just going to be we see lower company profits and it ends there. Why? Company profits are at an all-time high. It is absolutely absurd how much profit companies are making. There were a few graphs that I was looking at to come up with some numbers, but unfortunately, all of those graphs plotted company profits over the past 40 years or so, but don't adjust for inflation. So I didn't feel it's appropriate to put one of those graphs right here. So instead, what I did was I looked at how company profits have changed from 2020. So inflation's not as big of a concern. Corporate profits since 2020, according to the St. Louis Federal Reserve, have increased by 82%. That's insane. Seeing a company's profits almost double in 4 years is absurd. And it doesn't take a lot to say they can afford to pay a little bit more in taxes if they are making almost double the amount of profits. And they can reduce some of that. It's not like their spending has increased the same amount. Company profits are profits, not revenue. These are profits. So them having their profits go down a little bit because they're paying their fair share in taxes, that's pretty reasonable to me, in my opinion. So the big question, who will have to deal with the cost of these policies? In my opinion, it's going to fall on the companies. The companies are going to sit there and grumble and be annoyed. They're going to have a call with their shareholders. We're providing negative revenue guidance and earnings guidance and blah, 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 blah. Stock prices are going to fall a little bit and everyone's going to move on with their lives. That's that. The reality of it is, right now, companies are paying around 21 to 22% in taxes. The real number of what they're paying is around 16.8%. Before 2017, and we'll get to why that year in a moment, before 2017, the corporate tax rate was 35%. So we went from 35%, and companies were doing great. It's not like company profits suddenly started doing amazingly, and they were all suffering before 2017. Company profits were still going up. The changes to taxes in 2017 meant they just make more money. The incentives from COVID meant they make more money. The tax breaks from COVID meant they made more money. And they've still continued to make more money to this day. So in my opinion, the companies are probably going to bear that responsibility for paying their fair share of taxes. You and I do. Why should they get away with it, is my thought. So now let's look at the other side, because this was just the taxes. Let's talk CHIPS Act. This one's a lot easier. Decreased reliance on foreign chips, great. It may not make production of chips cheaper. The reality is, there's a reason we outsource a lot of our production. It's cheaper. But I don't think the price of products is going to change very much. And what it does is it will reduce our reliance on foreign countries and create a more competitive market. If right now the majority of chips that we're using are coming from 2 or 3 companies, what do you think is going to happen when all of a sudden there are 6 or 8 companies here in the US that are all competing? We're now working with a concept known as economies of scale. Basically, if you're making a lot of something, it's going to be cheaper per thing to make. So we're going to have more economies of scale because we're producing more, and we're going to have more ability for competition. More companies will open up and take advantage of these incentives. Some companies that might borrow or buy microchips from another company might start manufacturing themselves because there's money put aside for that. I think that it is not going to impact what we pay. So I don't think product prices are going to change very much. But what it will do is generate US jobs. More jobs in manufacturing, more jobs in technology and research and development. So the largest impacted sectors, in my opinion, are going to be the technology sector because, well, technology likes using semiconductors, and the industrial sector. Why? Manufacturing is expensive. It requires a lot of specialized equipment. And guess what sector provides and makes all of the equipment that they need? Industrials. So I see both of those sectors benefiting greatly from the CHIPS Act, and the CHIPS Act is a key part of the continued policy of the Democratic Party. But it might go away. The CHIPS Act might go away because right now there are many Republican leaders who are saying the CHIPS Act is a terrible idea. This is not the right way to try and bring jobs back to the US. It's going to take too long. It's too loose. There's no rules or requirements that companies need to follow. We want to get rid of it. That is not my opinion. That is a fact and quotes from key policy leaders from the Republican Party. They want to get rid of the CHIPS Act. So what do they want to replace it with? Well, we'll get to that in a moment. But really quick, let's talk taxes. Bet no one's excited to hear those words. Let's look at it really quickly, though. Remember how I said in 2017, corporate tax rates went from 35% down to 21%? Well, that was a tax cut that President Trump had made at the time. Those tax cuts lasted from 2017 to 2025. So the key policy that the Republican Party has is to extend those tax cuts through further out into the future. We don't know the exact date yet, but they want to continue that 21% tax rate for corporations. But they also want to bring that lower. They want to bring that 21% number down even further below 20%. They also want to remove tax credits and incentives and rebates for green energy. They want to get rid of the initiatives for adding solar panels to your house or buying an electric car. They want to remove funding for clean energy and clean energy companies to expand their infrastructure. And here's the big one. They want to add a 20 to 100% tariff on imported goods. We'll get to that in a moment. Let's just quickly talk about the rest of the tax plan. These tax cuts would reduce taxes for everybody. Every single group, every single tax bracket will pay less in taxes under the Republicans' proposed plan. But unlike the Democrats' plan, where the largest benefits would be going to the lowest income people, and the only group that would be paying more in taxes are people that are making $900,000 or more, the Republican plan would see the richest 5% getting the largest tax cuts. How much they would get in tax cuts is around 2 to 4%. The other 95% will be still getting a tax cut, but how much they're getting decreases the lower the tax bracket is, with people in the lowest tax bracket seeing the smallest decrease in taxes paid. Now let's talk tariffs. This is the big one. Tariffs might be a slightly new term to many of you, so let's quickly define it. Tariffs are like a tax that is put on imported goods. So if you buy a product from China to import in to use for manufacturing, you need to pay that tariff. Tax cuts would be beneficial, but how would tariffs affect us? This slide right here, this one and the one after it. I got you. So tariffs are taxes put on imported goods, but they are not paid by the company who is bringing those goods in to the US. They are paid by the importing company. So for example, if Taiwan Semiconductor sold NVIDIA $1 million worth of chips, NVIDIA would be the company paying the tariffs, not the foreign company. This is not an instance of we're going to implement tariffs and the other guys are going to pay for it. This is a case of we're implementing a tariff and you are going to pay for it. Why? Well, the goal is to increase domestic production and increase jobs. Same idea as the CHIPS Act, but expand it to all industries and all positions. They want to see more jobs and more opportunities here in the US. That sounds great. That is a really good idea in theory, until you look at what the actual percentages are. The current proposed tariffs range from 20% for every other country that's not the US, to 60% for China, and up to 100% in tariffs for goods from Mexico. What does that mean? If you are buying something that is $5 and importing it, it's going to cost you $5 plus $5 in tariffs. The cost of things from Mexico that are imported to the US are going to double. And who is going to eat the cost? It's not China, it's not Mexico, it's us. US consumers are going to bear the majority of this cost in the form of inflation. If all of a sudden the cost of producing something doubles overnight, that's going to send inflation sky high. All of a sudden, we are the ones eating that cost in the form of inflation and higher costs. And shareholders are going to be the other ones. Because what's going to happen when all of a sudden NVIDIA can't get the products that they need? Yes, the price of NVIDIA products is going to skyrocket, but their sales are going to decline. It's the same thing we've talked about before when we've talked about recessions and how recessions come to be. We're seeing the same thing here. This would likely force the US into a period of economic recession. Costs would skyrocket. People don't want to pay those costs anymore. Companies' profits go down. They start laying people off. And that doesn't create jobs, that destroys jobs. It might create new jobs over time, but in the short term, those jobs aren't going to be picked up automatically. They're not going to be picked up instantly. So, how are these policies going to impact stocks? Well, let's look at the dollars and cents of what we're talking about here. In 2021, according to the Bureau of Industry and Security for the United States, the US imported $2.8 trillion worth of goods from foreign countries. Just take that one number, tack on 20%, that is how much it would cost the US in 1 year. Let's now look at China. In 2021, 18% of these imports were from China. So $2.8 trillion, it's no longer 20% of that. It's now a lot of that, but also from China, it's 18% of $2.8 trillion. And that has a 60% tariff on it. That is a huge chunk of our imports that are all of a sudden have gone up by 60% in price. But that was 2021. China was our largest importing partner. In 2023, for the first time since China became our largest partner, we saw a change. China became our second largest importing partner, overtaken by Mexico. In 2023, Mexico imported $493.1 billion worth of product into the United States. Those proposed tariffs want to see that number double. So $493 billion is not going to cost us $493 billion. It's going to cost us just north of $980 billion. For the same goods, no benefits included. So seeing those costs rise by 60 to 100%, in my opinion, is going to cause massive, lasting damage to our economy. In the long run, we'll probably be fine. We'll move production domestically. But that's going to take a very long time. And here's some food for thought. The current unemployment rate in the US is 4.1%. Around 3 to 4% is considered to be normal. That's what you would expect to see in a healthy economy. It's not 0%, it's 3 to 4%. Where are all those jobs going to come from? Who's going to take those jobs? It's going to make jobs more competitive, which means that the amount that people make will probably go up. But right now, there's no need for more jobs. Except there might be. I don't remember the source, so I will tell you right now, this is unsourced, and the only place that I got this information was from the same source as a few other pieces of information here. Let me find what it was called. The Institute of Taxation and Economic Policy. That's it. In their article, talking about the implications of these changes, they stated that 5% of the US labor force is undocumented. Part of the Republicans' plan outside the economy is to either incarcerate or deport that 5%. So there would be opportunity for people to get jobs, but again, you're doing more damage than good. It's like saying you fixed a broken arm by cutting off the entire arm. Sure, your arm's not hurting anymore because the bone's not broken because it's lying on the floor. That doesn't help us. You do way more damage by implementing tariffs than you do providing benefits. You're not training the dog by teaching it good habits. You're punishing the dog for something that it doesn't even know is right or wrong. So I'm getting too far into this. The reality of it is we're going to probably see massive lasting damage to our economy. That is not my sole opinion. That is the exact conclusions that taxation and policy document says. If you want to go read it for yourself, I highly encourage it. It is a very detailed analysis, and they come to the same conclusion that I do. And as a result, prices of stocks will likely drop significantly, especially the technology sector. The technology sector would be demolished for years. All of a sudden, you have doubled the cost of their imported goods, and you've provided no support or funding to increase production here in the US. So, while we might see some jobs be created, the recession that these impacts these tariffs would cause would likely create way more damage than it did solve problems. Are political decisions made autonomously by the president, or do they depend on the decision of the chambers? Because it would also depend on the majority of the seats in the Senate. Amazing question. It depends. Certain policies can get passed by the president alone. Tariffs, I'm 90% sure, I'm not 100% sure, are something that he could pass on his own. Or they could pass on their own. House, we do not know who is going to hold the House in 2025 and 2026. We are very sure that Republicans would hold Senate. So if Senate is controlled by Republicans, the presidency is controlled by Republicans, and House is close, we could see these tariffs go through without a problem. Again, I'm not 100% sure on that. I could be wrong, so please do some research on that. I will implore you to do research on that. But for the most part, this is not just his policy. These are policies that are being echoed by the entire party. So as long as there are enough people that agree with this idea, it would go through. So ultimately, that is their platform. Their platform is increase jobs and production in the US, not through subsidy or not through investment into our economy. Instead, by punishing existing economies and making it more expensive and basically beating other companies into compliance is where we've gotten to with that. So that's the stock market. You've got my thoughts on that, and probably a little bit more than I probably should have gone into. Sorry. Again, I look at this very much from an economics perspective, and tariffs make no sense to me at all. There's no reason that that should be the solution. Increase funding. Give people more money to do the things we want. Don't punish people for just taking advantage of what is supposed to be a free economy. Bonds. Let's talk about bonds. Bond markets have been reacting very strongly to the election because federal bonds are seen as a defensive investment. I've talked in the past with you all about how when stocks are going down, bonds are typically going up because investors want somewhere safe to put their money. Bonds offer consistent returns that, in the case of federal bonds, are backed by the U.S. Treasury Department. And they'll typically see their yields rise during periods of economic uncertainty, especially when we think inflation is going to start going up. And the more uncertain people are, the higher the yield of short-term bonds. So we can look at bonds and bond yields as a way of figuring out how worried are people and over what period of time are they worried. So what's going on in the bond market right now? Here are the yields. Since September 9th of 2024, the Treasury bond yields have gone up by 19%. The current yield for a 10-year Treasury bond sits at 4.28%. 8-week bonds sit at 4.61%. And 2-year bonds sit at 4.20%. What does that mean? We've got 10-year bonds offering 4.28%. And in a perfect economy, if everyone was happy and the tank was clean, we would see 8-week having the lowest. Then we would see 2-year, then 10-year. The fact that we're not seeing that means that something strange is going on here. And the fact that the 8-week is the highest means that investors into bonds are pretty worried about what's going to happen over the next 8 weeks. So, do I think this is cause for concern and that we should take all of our money out of stocks and move it into bonds? First off, this is my opinion, not advice. In my opinion, we're not completely upside down. The bond yield curve is still positive. Barely. If that 2-year bond goes goes above the yield of the 10-year, we'll be having another conversation. Right now, it's not there. The 8-week bond being that high just makes me think people are nervous about what's going to happen over the next 2 months. But long term, people aren't that concerned. But what about stock investors? Where are investors' heads at? Well, according to the AAII, investor confidence has dropped significantly over the past month. The percent of investors that were feeling that the market would go up over the next 6 months has gone down from 49% to 39%. Meanwhile, the percent of investors feeling the market will go down over the next 6 months has gone from 20% to 30%. So people are getting a little bit more worried. And much like the bond markets, what we can draw from this is that investors are not so sure about where things are going to be in the order of 2 to 6 months. 2 to 10 years, they're a little bit more confident. So, do I think this year is going to follow the trends that we've seen in past years? Not a chance. Because leading into election day, this year's market is anything but normal. First off, we have some of the most extreme policies that have been suggested in my research in my time. I've never seen any policies as severe as 20 to 100% tariffs. Now, let's talk market. SPY's average return in the years before an election has been 5.89%. Currently, the 1-year return of SPY is 32%. The market is going to the moon. And it's not a single sector. every sector except for Pobrecito Energy has been thriving. So that makes us have more questions than it does have answers, because there's a lot more room for us to fall. We've got a crazy amount of profit built up. There's a lot more room for us to fall. So now let's wrap things up with my opinion of if one candidate wins or the other candidate wins. If Harris wins, we're probably going to see the stock market fall in the first week. Welcome to the stock market. According to a CNBC article, the average market change in the week following an election, regardless of who won, was a loss of 0.84%. But within the first month after the election, the average return goes up to a 0.4% gain. So, in my opinion, we're probably going to see a bigger change. There's more room for us to lose, and the reality of it is people are way more polarized about this election than they have been in the past. If you want to know my position on politics, it's make politics boring again. I miss when politics were just boring and weren't headline news. If Harris is the incumbent, my personal opinion is that the technology sector will rise. I feel that a lot of technology's troubles over the past few weeks and months has really been due to people bracing for the crazy tariffs and the possibility that those tariffs could be implemented. So I think that we would likely see the technology sector rise, and especially the semiconductor industry through the ETF SOX. I think SOX would make an incredible rally in the month to 3 months following the election. If Trump wins, I think the market's going to sink as is typical, but recovery might look a little bit different. It's going to depend on how long it takes to implement those tariffs, but as he has stated, it's his plan from day one. And as we looked at earlier, markets on average do show smaller gains for Republican incumbent presidents. The 1 year after the election, we typically see a lower gain than we did for Democrats. It's impossible to know what the impact of the tariffs could be on the economy, and if they would get implemented, and when they would get implemented, and when the stock market would start to react. Is it Trump gets elected president, and before he's even in office, the market's plummeted with technology dragging everyone else down? I don't know. It could be once he's put into office and announces today is the day the tariffs start, is when we see the market tumble. But if you want something more than just wait and see, pay attention to bond markets. The bond markets and looking at the yield of different bond terms will be a very good, strong leading indicator, meaning it will help us know ahead of time what's going to come of the stock market in the coming weeks and months. And again, technology will probably be the sector to see the biggest losses, while the energy sector would likely see the biggest gains, benefiting significantly from the Republicans' tendency towards oil and gas as opposed to renewable energies. But the only thing that is certain is that nothing is certain, and only time will tell. This is election night. We don't even have all the answers. We don't have any of the answers, and only time will tell what the answers are and who will be the next president. But through this webinar, I hope that you've learned a little bit more about what policies each party has, how those policies might impact stocks, what history has shown us about how the market performs after an election, and given us a little bit more confidence that the market will be here to last another day, regardless of who wins. Thank you all so much for joining us. If you have anything you want to add or any questions, you can always email us at support@sectorsmadesimple.com. SMS subscribers, I will see you all tomorrow for another weekly analysis of our sector strategies, where we'll take a look at what's changed over the past week, who the new leaders are, and my thoughts about what we could expect over the coming week. For everyone else, I hope to see you all back at Sectors Made Simple very, very soon. Take care, and bye.